You asked if gold and silver are going to have a moonshot. I think they will, but it's going to be very interesting to watch. I think we're going to go back to 30, then we're going to jump to 50. And then things are going to get out of control, and we're going to go up to 80s in silver. Gold is going to be a little different.
Hello there, my friends. Chris Marcus here with you for Arcadia Economics, and today is part 2 of my interview with Jim Willie. In part 1, which was released on Friday, he talked about some of the history, what led to Lehman Brothers collapsing, the response to that, which has led to this situation we're in now where the president, the Federal Reserve say things are great, yet they're doing emergency bank funding lines. So today, Jim is going to explain what's happening now, how it plays out. So hit the subscribe button and enjoy. I mean, we have Hank Paulson, Ben Bernanke couldn't spot subprime even as it was imploding. Now we have, and Jim, you mentioned before, you have Donald Trump and Jerome Powell. I mean, to me, the audacity that, you know, you're already pumping in more money than during QE, yet they say, hey, everything's good, and set people up to get clobbered. So Jim, I really appreciate what you said. I think you're filling an integral service. Incredibly darn one of the most interesting, fascinating people, whether you're in finance or not, but just hearing that. So I appreciate you sharing that, and just wanted to add that for folks at home.
I'm not with a degree in economics, Chris. Keep that in mind. Oh, I just got a message saying my internet connection is not stable. Okay, I hope it steadies out here. We're
Yep,
okay
you're
now.
Good now.
Okay, we're good. One of the funniest things I ever did when I started this was not in the disclaimer, the legal disclaimer, and not in the portfolio or anything like that. It was in my bio that I put on the website, and I put on public articles. Jim Willie, doctorate in statistics from Carnegie Mellon, unencumbered by the limitations of economics credentials. That's a mouthful. What it means is I don't have the drawbacks and disadvantages of being trained in economics. I'm trained in statistics, so I'm trained in reality. I'm not trained in fairy tales and flawed theory like Keynesianism. Keynesianism really gets a bad rap. Keynesianism actually has a quality core, but its implementation has been totally bastardized and corrupted. Right. Keynesianism actually called for expanding the debt during bad times in order to build up the economy so that in the good times you can pay down the debt. But what we did was we engaged in constant war since Vietnam. Military buildup, constant military tension like in the Middle East. That was the game for 20 years, the Middle East. Oh my gosh. Yeah, but we created that conflict. Right. Very few people understand that the security protection for the Saudi royals is provided by Israel. I mean, the facts behind the scene are abominable. So while we were building up the war machine in the 60s and 70s, even more, because, you know, we had Vietnam, it was profitable. So we needed to continue that vein. We built up the social safety net. We expanded Medicare, Medicaid. I regard the $1.3 billion, $1.3 trillion. Sorry, Jim, you're off by a factor of 1,000. The $1.3 trillion for Medicare and Medicaid is nothing more than a Rockefeller subsidy. Okay, so we bastardized and corrupted the Keynesian thinking by building up the war machine and building up the social safety net so that we always had a big deficit. And in recession times, it was worse. In good times, it was big. So now we've gone out of control. You ask, how are we going to continue this? I have several questions that I'm going to try to address. We're going to continue this until the East pulls the plug or until our stage collapses. The Chinese don't want to be blamed for what's going on. That's one of the favorite lines that I hear from The Voice. They'll actually keep us propped up a little bit. They've actually lent us a bit of money. I don't know the exact amounts in order to get past October so that we didn't have a government shutdown and a default of the treasury bonds. Now, think of that when we're having a trade war with China. They lent us money to prevent our breakdown. That's aid. Now, you might say, well, they have $1 trillion in our treasury bond. Do they really, or have they swapped that out? Okay, we don't really know the facts, okay? So I believe we're reaching a point where the bond market is starting to break down on its own, and the evidence is the repo and the POMO. Repo is repurchases, where like in a 24-hour loan, JP Morgan can lend $1 billion worth of treasury bills and get some cash for it to manage their liquidity problem. And then a day later, they need to do something to resolve it or to repeat it. But think of it as a rollable credit card with the Fed, because I don't believe that in 24 hours they resolve it and it doesn't get repeated. I think a day later it gets put on again, maybe even bigger. Okay, that's a repo. The POMO is permanent open market operations. In other words, it's not a 24-hour loan to help with your liquidity. It's, we'll buy your bond and put it on the Fed's balance sheet. That's QE. I said in June, May, June, and July, I was really getting on the soapbox and yelling with the megaphone, we're going to infinite QE forever. And I'll harken back to March, April, May, when Fed Chair Powell said, we're going to have to make the bond purchasing structural. We're going to have to make it permanent. And I thought, well, permanent, that rhymes with forever. Okay, so I thought, okay, we got QE forever. All we're lacking now is the infinite part, because I was saying infinite QE forever. I want to talk about 0%, get to that. So we got some hints. The bond market was in big trouble last December when General Electric had to, they abused their bonds so badly for stock buybacks. They didn't invest in their company. They had faltering in their product lines and their business segments. They got downrated to triple B, which is not junk. Triple B is one step above junk. If it goes anything lower, lots of mutual funds and bond funds and pension funds will have to abandon or go down to no more than a certain fixed percent, which is not very high, like 8 or 10%. Okay, so the East is kind of giving water drop by drop to a man who's crossing a desert and who's about to fall flat on his face from the heat. And they'll give him a little bit more water and, maybe half a canteen and, a little bit of rice and beans, and he'll be able to make it another couple hundred yards, and then he'll drop down and they'll give him some more. Okay, this is what they're doing. They're feeding, you could say he's a man who's walking down a failed path in the desert, or you could say he's a man on death row going to his execution. Take your pick. I don't care what your analogy is. But with all the bond abandonment, all the dollar revolt and rejection, the U.S., and I said this a year ago, the U.S. is going to be forced to rely on machinery, their computer machinery. They would take the differential of the near 0% and the 2.5%, 3%, take the differential and work on that VIG and leverage it with futures contracts. And it's very important that when the short-term interest was near zero, that's a zero cost for a feeder system where they were arbitraging. In other words, working off the gap. Right. Now, if I were to say, hey, look, George, I'll lend you money for zero and you can buy treasury bonds for 2.5%. Oh, yeah, more the merrier. Bring it all in. I can make some pretty good interest rate on that. Well, when do I have to pay it back? Not at all, never. We'll give you some more next year.
Yep.
And make 25%, 25 times leverage on that by putting on futures contracts. We learned to do that way back in the 80s and 90s with Volcker. They were borrowing gold for 0% and buying treasury bonds, which were at 13%. They brought it down to 6%. Wall Street made $1 trillion. So they thought, well, we'll do it again, but now we'll do it off the dollar. But with a warning, when we're done, the dollar must declare bankruptcy. This is very deadly stuff. Okay. You asked if gold and silver are going to have a moonshot. I think they will, but it's going to be very interesting to watch. I think silver's going to follow Fibonacci sequence, like 8, 13, 21, 33, 55, 90 something. You know, I might be off by 1 or 2, but it's hard to just, you know, rattle it off. We got up to 50 6 years ago. Why 50? Well, it's kind of the Fibonacci sequence. 13, 21, 33, 54. That's very interesting. I think we're gonna repeat that. I think we're gonna go back to 30, then we're gonna jump to 50, and then things are gonna get out of control, and we're gonna go up to 80s in silver. Gold is gonna be a little different. Gold is gonna be, you know, waiting for the big event. They're gonna be waiting for like the COMEX to fail, or they're gonna be waiting for, this is much bigger likelihood than COMEX to fail. They're gonna be waiting for a key agent that works on the COMEX support mechanisms. The key agent is going to fail as a bank. Could be JP Morgan, could be HSBC.
Could Bank of America fit into that category too?
Only in that they're one of the lashed banks, lashed, L-A-S-H-E-D, that share in the derivative responsibility. They're all in it together now. It's not just the designated hitter of Morgan Stanley. They didn't want Morgan Stanley to be killed. They'd rather, okay, if you've got one really weak guy who can't hold the entire coffin, and if it's a U.S. military guy, it has 100 pounds of heroin in it, you bring on 5 other men. Okay, so you don't have just Morgan Stanley anymore. You have 6 or 8 big banks, and a couple of them are European. So Bank of America is definitely one of them. You asked, are we likely to see a Lehman type event? Yeah, I think we're going to see a Lehman type event with 3 or 4 or 5 banks dying. But here's how it's going to be different, Chris. I'm hearing rumors that Deutsche Bank declared bankruptcy last week.
Yeah, I've heard that.
I got rumors 2 weeks ago from a good source, and inside, not so much rumors like from a grapevine, not so much rumors like from a cloud descending on a room. I got a grapevine indication that Credit Suisse is dying. Credit Suisse is a different kind of story. They're Swiss. And I heard that they're having tremendous challenges in unwinding their giant derivative positions. What derivative position did they have? I think it was the euro, Swiss, dollar, gold arbitrage that took gold down from 1900 down to 1300 in the years 2012 to 2016. Now, we knew about the euro Swiss 120 peg because the Swiss were seeing too much European money coming into Switzerland as safe haven, driving up the Swiss franc, putting at risk their economy because they've got a significant export economy. So they put on a peg, but what they didn't tell us about was what I believe to be JP Morgan's integration of the dollar gold with their euro Swiss to make it a 4-way arbitrage and force down the dollar. And some of the evidence of that is the gigantic stock positions by the Swiss National Bank. What are they doing owning so much Apple stock for?
Right.
Okay, so now instead of Lehman dying and Fannie Mae croaking, we're going to see 4 or 5 or 6 banks failing, and you're going to struggle to even notice because they're going to do their dead level best to keep it secret. Now, I've been saying this is going to be 3 to 5 times bigger than Lehman. Let's just call it 4. Now, if they killed and if they were killed or died, Lehman and Fannie Mae, that's 8. 2 times 4 is 8. We're going to see at least 6 banks die, and we're not going to hear about it. Okay, Deutsche Bank, Credit Suisse, JP Morgan, and maybe let's add on 3 more. Wells Fargo, Citibank, and Society General. Now, I just heard about a 7th today. Very, very likely. HSBC. They're embattled. The Chinese are trying to take control of it. They're having difficulty with the British resistance. And now we're starting to see things like sabotage of HSBC until they relent and have certain forced resignations. In other words, the British get out so the Chinese can come in on their board of directors. It's getting very, very nasty, and HSBC is coming up in little, I don't like calling them rumor mills. Let's just call it analytic conjecture. There's suspicion because a new category called pledged gold has come up with the COMEX, and HSBC is right next to it. So it looks like they've got a squeeze. It looks like they're caught way short. And we could be seeing an incident where HSBC might be in a death spiral because of their gold position. What's happened with gold? Well, it's up $150 in the last 2 or 3 months. It might go higher. So they're doing their utmost to try to drive down the gold price, I think, to save JP Morgan, Credit Suisse, and HSBC.
And Jim,
I think we're going to go ahead.
A quick question on that. Something I've been wondering, especially we hear, there's the COMEX contracts, God knows what the true amount of derivatives piled on top of that is. So when you had these rallies in gold and silver over the last couple months, I hear they do get some form of margin call. Obviously, there's an open loss. And I wonder, from this banker mentality, are they just arrogant enough that, hey, no matter what happens, we'll slam more and we'll win? Or are these guys getting worried where if you're short an asset that its fair value is significantly higher, your only incentive to continue shorting is if you can drive it down? And I wonder, are these guys getting a little nervous yet?
Yeah.
Especially with whether it's a legit investigation into the precious metals manipulation or not. But I mean, it's like they would have to smoke it in front of that investigation on top of it.
They're getting very worried, Chris. Here's kind of how I think about it. I think in practical terms. If a big bank is way short, they need a patch job. And now you enter into a domain of risk. Will they properly and accurately estimate what they need, or will they run out of their credit line? A third point, is there any personal family fortune at risk? So it's misjudging, running out of credit line, or risking your family fortune where, our family had $84 billion, but if this thing goes bad, we're going to have 5. And that's when they pull a plug. I think we're going to have some other types of problems that, some analysts talk about, I think about a lot. Is it possible that JP Morgan, which is running the derivative machinery, is it possible that some of their disaster scenarios and simulations weren't really well done? Take a look at some of the stress tests. Now, I realize that they are intentionally falsified to enable passage.
Right.
We've had like 15 or 20 companies fail and go bankrupt after passing stress tests. It's becoming a bit of a joke. But when it comes to disaster scenarios and simulations, I come from a computer science background. I don't have a mathematics college degree. I had a math minor, math and stats. But my degree was in computer science, programming, and data structures, and it was fun. I thought it was a lot of fun. I didn't have, this is going to sound a little strange, I didn't have the mental maturity until I turned 20. And I graduated from college a year early, 21. So when I got to master's level, that's when I started taking some more math courses, and I backed out of a graduate program, Ivy League statistics doctoral program, and went to Carnegie Mellon and spent 2 years bridging a gap. But I learned a lot about simulation, and we have a saying in simulation: the quality of the simulation results are as high as the quality of your input feeder system, of your platforms, your rules basis, your conjured threats, your reactive modality. Let me keep it much simpler. If you do a simulation where you got garbage in, you're going to get garbage out. You do a simulation that's kind of Mickey Mouse and not sophisticated and really didn't do your homework and really didn't set all the parameters really well and didn't have the limits, you're going to get a simulation that's not going to really help you in a crisis. And that's what I think is a big risk for the computer machinery that's often called the derivative shop. And JP Morgan and Goldman Sachs are involved running that. The Department of Treasury is in charge of that. And I think they're going to get overwhelmed. That's what I think. And I think the evidence is going to be a shooting up of this gold and silver prices. And I'm hearing a lot from smart people who I respect that the shooting up in price, the big breakout, is going to happen with gold and silver later. And I'm thinking, well, maybe. What's your basis of that? Well, gold is going to be the monetary metal and silver is going to be the technology metal. And I say, where's the industrial shortage? It's with silver. Where's the industrial supply lacking? Like in Mexico, Peru, and Chile, even Russia. It's silver. Right. Okay, so I think we're going to see price movements in gold and silver. As for overnight, you know, as long as we got the ability to do patches, I don't know about any overnight problem, but, you know, let me put a caveat there. Back in August, there was 40 billion a night. Back in September, it was like a little more. In early October, it was 40 billion, and then by late October, it was 80 billion a night. Talk about the overnight repos, the emergency funding on short-term loans not to go on the Fed balance sheet. And now it's $250 billion a night, a good chunk of which is going on the Fed balance sheet. Okay, now, I don't believe in straight line thinking. A lot of people do, but I've learned a lot. You know, if you do straight line thinking, then you're going to have a 3-second 100-yard dash coming pretty soon. If you do straight line thinking, you're not going to get the 4-minute mile. You're going to get a 2.5-minute mile. In other words, you're going to get something stupid. No, you get asymptotic movement. It's not linear. It moves toward a bound. And I think what we're going to get with the overnight and the POMO, the permanent operation, going to the Fed balance sheet, I think we're going to get an explosion. I think it's not going to be so much an asymptote, meaning it'll go up and try to find a level like 520 billion a night. No, I don't think that's going to happen. I think it's going to go up and have dangerous spikes like what we saw in the repo rate. It went up to something like 2.5% overnight back in the summer, when the norm is less than 0.5%. I may not get the figure right, but you get the point. It's a big spike, right, and it then came back down. I think we're going to get some spikes. Like they're going to lie about it. It'd be like 600 billion overnight, right before Christmas. They're having to fund end of year problems, budgets, various things. The end of the year is far more dangerous than the regular part of the year. So I'm looking for overnight spikes and lies. You know, you hear the phrase, where there's smoke, there's fire. We're going to see a lot of smoke coming soon. And I think they're going to have trouble keeping secret if 3 big banks go bankrupt, if they enter financial failure. Because here's why. They're going to do their best to keep it quiet. They're going to do the best they can to keep the funding data quiet. But they're not going to be able to keep quiet all the creditors. They're going to be marched up and line up at the door. And some of them are going to be pissed off. And some of them are going to talk. And they're going to talk to like a Barron's analyst in a supermarket. And it's going to show up as a reliable source, caught over the weekend, no details, but here's the data. And it's going to be about a failure like Credit Suisse, or it's going to be like 738 billion overnight, 2 straight nights over 700, and they're not going to be able to keep a lid on this. Let me make a last comment. We're kind of running out of time. Last comment about 0%. There's a lot of talk about 0%. and negative rates. A lot of people have asked me, Jim, how come the German Bund has gone to negative and stayed negative? Well, here's an argument that was put forth by Euroraj, and he's one of my very solid, very smart buddies on the Jackass colleague crew. And there are 9 of us. The Voice is 1. The Voice has been very busy the last 2 or 3 years. I give him, it's not like I'm being critical. He's very busy with high-level projects, and he pitches in once in a while and says something very interesting and very helpful, like the Saudis are bankrupt, Jim. Aramco is never going to happen. Stuff like that. But here's a Euroraj argument. You've got about 1.5% or 2%, more like 2% differential between the German Bund and the US Treasury bond. Multiply by the maturity length of 20 years, 15 years, and you get a 30% differential. He's saying the euro is indirectly telling us that the dollar is 30% overvalued. Now, that's an interesting way of looking at it. The differential on the yield multiplied by the maturity, what do you get? That's the differential built in to an annualized, amortized concept. Very interesting. And it appeals to the mathematician in me. A lot of people don't know the difference between statistics and mathematics. It's kind of fun. I was actually bored a bit by statistics. I was fascinated by probability and fascinated by probability models whose implementation is a statistical procedure. I like the formation of the statistical procedure built on the math structure. My whole thesis for the doctorate is 0 statistics. It's all probability. Okay, so the differential favors Germany on the negative side, and they must keep their bond rally moving. So they make it more negative. And it starts to get up a little bit towards zero, then they push it back down because they don't want abandonment of German bondholders. Got to maintain the principal value of these bondholders' holdings. And then I get the question, my gosh, it looks like, most of Europe is negative. You got $8 trillion, $9 trillion in sovereign bonds, meaning government-sponsored official bonds, that are in negative yield territory. Is the U.S. next? And a lot of people are saying it has to be. It will be. There's no other way. And I say, oh yeah, there's another way. There's another way. Instead of saying, well, we're going to favor the treasury bonds because they're, down at 0.28%, under 0.3%, staring at 0 in a few months. We favor that to the Germans, which are now at minus, say, 0.8%. And I say, no, I don't think we're going there. When you get down to small numbers on U.S. Treasury bond yield, you're going to have an abandonment in favor of gold. That's what I think. It's going to be led by the Asians, the East. It's going to be followed by what I call the frontier section, the frontier region, which includes Germany and Iran and Saudi, the Gulf. I don't think Oman is going to sit tight and go to negative rates. What, and pay the Federal Reserve? Pay the criminal hive? I don't think so. No, when we get down below 1, you're going to start seeing sparks like you do on a third rail of an electric train track. When you get below 1, you get toward like 0.5 on a treasury bond. You're going to see a lot of abandonment. You're going to see a lot of smoke coming out of the derivative offices where the machinery is working overtime from the dumping of treasuries. No, I think 0% is the third rail. It's like the pole, electrical pole that never gets touched because the forces get too powerful when you get near it. So negative rates, I don't see it. And why? Because it's the dollar and the treasury bond, which are the standard for central bank reserve systems. South Korea, what do they have? 130 billion, 160 billion? I don't know exactly. They got a good slice of treasury bonds, unless they swap them out. But if they haven't swapped, They got, say, 150 billion in treasuries. Are they really going to give a paycheck every month to the Fed with negative rates? I don't think so. This paper money concept, it's new in the last century. It's an abomination. And I think we're going to see some tremendous moves in gold and silver together. And, you got to look at some of the patterns. The Deutsche Bank stock price, it's moving kind of like Lehman did. Just down, 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 little bumps, down, down, down. And there are other charts like the S&P, the blow-off that's going, the blow-off top that we have now. It's matching like the 19-teens and the 1920s. Forget the value. Just look at the ratio. Call everything 100. Ratio, fix it to 100. And what are the movement? We're seeing the beginning of a real explosive, controversial, chaotic time. I think they're going to have trouble keeping order in this. I love the phrase. It's going to be like herding cats. You got the back of your little mini truck, like it's camioneta in Spanish. A mini truck pickup. You got a little mini pickup truck, and you got 30 cats in the back, and they're very impatient to get out. You open it up, and they run out on the field, and now you got 2 hours to collect them all. Are you kidding me? This is what's coming, and it's not avoidable. They're not going to be able to herd these cats, not unless they poison them. They're not going to be able to herd these cats. The cats are going to be the dollar, bonds, and gold. They're going to go all over the place, and they're not going to be able to control the gold price. They're not going to be able to control the bonds that are being abandoned and swapped out. And not much conversation is coming for the swapping. So exciting times, truly. I am never bored reading my inbox. I'm just sometimes in kind of a bad mood from personal issues, and I hope people can continue to help me out. I don't want to say go help me out. Continue to help me out with the donate button. I'm going to get through this, Chris. It's kind of like, well, you're going to get through it, but what are you going to look like on the other side? And I hope I don't have heart problems, because I'm dealing with a lot of stress. When I hang up this phone, I'm going to deal with a stressful situation today. And trying to make it go away, and it's not going to be easy. Take some negotiation. And tomorrow I've got a different stressful situation to deal with. So I try to, get up early in the morning, work till 2 or 3, and then the later afternoon deal with the stressful situations. And it's tough. It's a long list. It's tough, and the list is getting shorter. And the problems are getting smaller, but they're not going away.
Well, so, Jim, I was just going to say, I sure appreciate what you're doing. And I think all of us in different ways, we've gone through challenging times in our lives. And, I appreciate that you keep going through that, because in the end, that's the only thing we can do. And perhaps just in wrapping up, you could mention the website again, and for folks that are able to help support. So again, we can continue having you on the show, continue getting this information that we're paying all this money to taxes and our government leaders aren't protecting us. You're filling that role. So again, if you could just mention how folks can support you.
Last January, with the help of a very fine client, a professional in the website development, marketing, search engine, that whole sector, we set up a new website. The old one was www.golden-jackass.com. This one is golden-jackass.com. A nice passover of rights and protection. And this new website is much more friendly to the extremely popular and growing portable base of users. He cited a survey. 3 years ago, something like 30% of internet usage in Europe was with portable devices. But a year ago, it was up to 60, or 18 months ago, it was up to 60. It doubled in about 4 years. And I've got some internet usage, but for me, I'm about 95% PC. because I've got to do my work and interact, you know, a lot of cutting and pasting and sending an email, and I can't do it on a little, I don't want a tablet. I don't, my brother's got a tablet. It's very nice. And I said, oh, that's great, John. You can check out the false information on New York Times very easily. But the new website also has better graphics, a wider format, and it's just a whole lot better. I got hundreds of nice compliments, and I pass them all over to my guy, and he likes getting that feedback. So on the website, there is a lot of public content. I haven't had a portable article, a public article, but I'm writing one right now about the possible triggers, and I thought we might get to that, but that's okay. That's okay. It'll go on another interview with you or someone else, doesn't matter. I've got a list of 15 triggers, and we touched on many of them. I'm going to have to add one now. Credit Suisse failing, HSB's failing, either one. So public articles and public interviews are displayed on this site, not on the members area, in the open public domain. And I hope people can check them out and come up to speed in a number of areas. It's very hard for people who've got a regular job to keep up with everything that's going on. And what I try to do is provide a monthly report. It's 45 or 50 pages each month. And for people who are just too busy, you know, pick your favorite 2 or 3 chapters. And if you insist on looking at all the chapters, you don't have a lot of time, then read the little synopsis. It's 4 to 8 lines per story, and bounce from story to story. You can cover a chapter in, you know, 15 minutes or 10 minutes. But I hope people can sign up. The best thing you can do to help me out is to sign up for the newsletter. But that's really not true. The best thing you can do to help me out is hit the donate button and tell me in a nice email message, I'd like to give much more further to help you in your survival, which incredibly about 5 clients did. One of them wasn't even a client. A little message saying, give me your data for a wire transfer. Unbelievably generous people. And I try to contact each one of them who make big donations. There have been a few. They're not many. They're less than the number of fingers that you carry in your pockets. But go to the donate button, and if you want, click on why donate, and you'll get a description of what happened with the fraud and faulty construction and other problems like car crashes. I make a quick reference to the demonic angle that's potentially at work. For me, in my mind, I say 90% certain that this is somewhat demonic, because I've gotten some new events in just the last 2 months that reinforce that. I'd rather not get into details, but they have to do with medical bills. So, you know, the newsletter itself, we've got 15 and a half years now. This month, I mark it on the calendar. I mean, flip the month on the calendar, add a number on the upper right. It says 188. 15 years is 180. I never thought this would happen. I thought the dollar would be replaced by 2010 and we'd go to the gold standard by 2011 and 12. A lot of people thought that, but we never expected or anticipated the level of corruption, the level of war threat, or the level of QE, you know, Zimbabwe type central banking. We never expected even the derivative machinery to be put into gear. Most people don't even know about it. I know smart people who've never even heard of it. Okay, so I've got a 50-page report, 45-page report each month. It's a labor of love. It's actually a little bit hard to start. I get overwhelmed. And then I use something that my mother used to teach me. She said, Jim, the hardest thing is starting. Find something that you really like and start with it. So I start usually with my favorite chapter, and I build it. And while I'm doing so, I fill in the introduction with this miscellaneous stories, because they're always miscellaneous things, don't fit in anything, but they're very interesting, and together they make a nice plate. So, you know, this is interesting, Chris. This is the most interesting job I've ever had. No, I shouldn't say it. The most stimulating job I've ever had. The most interesting was my job at Digital Equipment Corporation doing marketing research. That was the most interesting, because I actually learned about, you know, additional multivariate type modeling procedures like factor analysis. Didn't never use cluster analysis, but I kept reading, looking for a place to use it, couldn't use it. Cluster analysis is kind of interesting. If you take, like, say, 20 data series, like percentage manufacturing, percentage agricultural, percentage of your population under 30, a percentage of your population with college degrees, population per square mile, all these different demographics. And then you put all 50 states and do a cluster analysis, you find Ohio, Illinois, and Michigan are all together. And there's Pennsylvania close by, Pennsylvania, New Jersey, all together, Hawaii all by itself, Alaska all by itself. And that's cluster analysis. And that was my most interesting job, and I loved it. And my fondest years were working with some people that I've kept up with, two people I've kept up with. And one of them just had a stroke from my digital years in the 80s. So here he is in his 60s, and I've got good health with a threat of stress. He doesn't have good health with a threat of a heart stent and a stroke. He almost died 2 years ago, my best buddy from those years. So I kind of lost my best buddy because he doesn't keep up as well, doesn't return the phone call. He said, Jim, I don't want to get into all that stuff. Okay, that's all right. Well, let's just talk about the New England Patriots. They lost. That was a bad loss to Baltimore Ravens. That was bad. After the first quarter.
Can't have my Jets on your schedule every week, right?
Man, talk about horrible upper management. But anyway,
I was thinking at least the Jets haven't lost again yet this week. Although I heard now Adam Gase is locked in for next year too. So the Jets goes bad even when they're not playing.
I was going to say you can't lose on Tuesday, Wednesday. But you can on Monday and Thursday. I actually don't like the Thursday night game. I think it messes up their schedules. It messes up their internal clocks, messes up their practice schedule, messes up their recovery time from very serious contact sports. But, it's fun to watch. It's fun to watch. And there are a lot of really good players out there. If it weren't for professional sports and college sports, I think I would have gone nuts by now. And I got some good friends that say, well, Jim, if it weren't for skirts, you'd go nuts by now. Well, okay, yeah, maybe. Nothing is easy here. I tell you, I'm going to have a lot of memories. And the boys are telling me, Jim, someday you need to write a book and to focus on your pièce de résistance, the forecast of the Lehman crash. And I said, add a few years, my sir, and 2 chapters, the Lehman crash and the 2020 crash. I don't even know what to call this. Some people call it the omnibus bond crash. I don't like that name. I call this the systemic Lehman crash. Yep. It's systemic. It's just like Lehman. It's just bigger. Some people call it the everything bond bubble crash. I don't like that. That's as bad as omnibus bond bubble crash. Systemic Lehman crash. I've been saying for 3 or 4 years, we're moving toward a systemic Lehman moment, and the subprime bond is U.S. Treasuries. And the Wall Street bank sector is the entire dollar structure. So we're moving toward a gold standard. I haven't talked much about the gold standard, but let me just say that I think the Basel Plan is going to come into work. The 1980s Basel Plan by Zijlstra, their chairman of the board, which was endorsed in the 2000 decade by William White. And it says that once these big central banks get overloaded with impaired bonds and approach an insolvent state, they're going to load up on gold, do it quietly, and then engineer a 10 to 15-fold increase in the gold price to get out of their insolvent situation. That's what I think is going on right now. Central banks are loading up on gold and not telling anything about it, and using false accounting and using closely aligned financial affiliated firms to do the buying on the quiet. That's what I think is going on, Chris. That's a nice note to close on, because it means the central banks are going to engineer a $15,000 gold price.
And again, just one last time, I'll mention that for anyone who wants to be ahead of the curve on how these things go down, you can go to golden-jackass.com, get the hat trick letter. Jim, it's really a pleasure to catch up with you. I know, and you even mentioned it, it's not always the lightest, easiest stuff to dig into. I sure am darn grateful for all that you do and all that you share. And again, golden-jackass, folks, go check it out. And Jim, it's been a
Sign
real
up,
pleasure
make a
today.
donation. Actually, 20 people did both. I'm trying to count them. It's incredible. A guy last week signed up, made a $50 donation. 2 weeks ago, guy signed up, made a $100 donation. It blows me away. I'm very grateful. I'll never forget, with my gratitude, the help that I'm getting. I'll never forget it. Okay, thanks for having me on, Chris. It was fun.
All right, sir. Sure was a pleasure. We'll look forward to catching up again soon.
Okay, all right, bye now.